There's been a lot of talk recently about the US and their enormous pile of debt, $36.8 trillion worth to be precise. And as interest rates have risen in recent years, this pile of debt is becoming a bigger and bigger problem for the Americans. In fact, they now have to spend over $1 trillion each year just in interest payments. And the debt pile is only getting larger, as the US government is spending way more than it collects in tax revenue, so they're forced to borrow in order to make up the difference. In fact, many analysts believe this debt problem is becoming so bad that the US government is at risk of a full-blown debt doom loop, which is essentially where high interest payments forces the government to borrow more in order to make these interest payments, which then leads to a higher interest burden, which then forces them to borrow even more, and so on, creating a vicious cycle. Trump himself is acutely aware of this problem and is willing to get creative to solve it, with some people arguing that he's even considering just refusing to pay some of the debt back. But what could actually happen if the US government decided to default on some of its debt? Would global markets collapse? What could happen to the price of gold and other currencies as a response? And how likely is this to actually happen? This video will discuss these questions, but to begin with, I think it's important to think about what US government debt actually is, and why it's so important to global financial markets and the global economy as a whole, and why a default on this debt could trigger a 2008-style financial crisis. So to really understand this issue, I think it's worth taking a step back to think about what government or sovereign debt actually is, and why US government debt in particular is so important and why it's seen to be the cornerstone of the global financial system. At the absolute basic, sovereign debt or government debt is the same as any other debt. It's the borrowing of money with a promise to pay it back in future, along with interest payments along the way. The only difference is the entity doing the borrowing in this case is a government, rather than an individual or a company. And governments will borrow money for a number of different reasons, but the main reason why governments need to borrow is if they spend more than they bring in via taxes. This situation is known as a budget deficit and happens all the time with governments all around the world. As I mentioned earlier, the US government is currently spending way more than they bring in via their tax revenue, so they need to borrow money in order to make up this difference. So to actually borrow the money, governments will usually issue bonds, which is essentially just a promise to pay back the face value of the bond at a given date in the future. And interest payments will also be made, usually every year. In the UK, these bonds are known as gilts, and in the US, these bonds are commonly known as treasuries. So those are the basics. But it's still unclear why US government bonds in particular are so important to financial markets and so central to the global economy as a whole. Well, this is mainly down to three main factors. Firstly, for many decades, US treasuries have been one of the safest and most stable places to store large amounts of value over long periods of time. In its 250-year history, the United States has never defaulted on any of its sovereign debt. And up until recently, it was generally accepted that there was basically a 0% chance that it would ever default on any of its current debt, or even miss any interest payments. Also, treasuries offer a predetermined interest rate, known as the coupon rate, which is paid at regular intervals in time. So investors will know exactly the returns that will be generated from their investment, and exactly when they'll be paid. Secondly, US treasuries are denominated in dollars, meaning that all of the interest payments and the repayment of the bond upon its maturity will be made by the US government in US dollars. And as the dollar is seen as the safest and most reliable currency in the world, the safety and reliability of US government bonds is therefore increased further. And thirdly, the market for US treasuries is incredibly liquid, meaning that treasuries can be bought and sold among investors almost immediately, and you won't have to wait for a buyer to come along if you want to sell your bonds, and vice versa, no matter how many you have to buy or sell. This is because the US economy is so enormous and have issued an immense amount of bonds in the past and continue to do so, meaning that there are huge amounts of these bonds circulating in the market. So it's these three factors of the risk-free nature of treasuries, the safety and reliability of the US dollar, and the liquidity of the treasury market, which makes US treasuries so incredibly useful and desirable to investors around the world. Think of it like this. Let's say you're a pension fund with $1 billion worth of cash sat in a bank account. Now, this cash doesn't belong to you, it belongs to your clients who have chosen to hold their pension pots with your particular fund. And let's say that your clients are nearing their retirement age, so they want to take as little risk as possible with their pension pots. Now, in this situation, you, as the pension fund manager, have a number of different options. You could just keep this $1 billion in a bank account somewhere. However, this really isn't a very good thing to do, as if the bank goes bankrupt and there isn't a government bailout, then you could lose basically all of this money. Alternatively, you could withdraw it as physical cash and keep it in a vault somewhere. However, this is really impractical and the security costs and storage costs would be really high. and also the cash would just sit there and not accumulate any interest. Another option would be to turn the $1 billion worth of cash into something like gold and store that in a vault. However, you've still got the issues about practicality and storage and security costs. And also the price of gold isn't necessarily stable, so it risks losing its value over time, which your clients have said that they don't want. So a practical solution for you would be to invest the $1 billion in US Treasuries, as they're basically risk-free and offer a known investment return. You know exactly how much interest you're going to earn, when you'll be paid, and when the bond will mature. Also, we know that the market for these bonds is super liquid, so getting your hands on $1 billion worth won't be a problem at all. And if any of your clients want to cash out their pension early, then you'll be able to sell any of these bonds at a moment's notice without an issue. So hopefully this example shows just how useful US Treasuries can be to investors, especially institutional investors like big pension funds. And because Treasuries are so useful, and because there's so many of them, we know that the US government has borrowed just shy of $37 trillion. Almost all big banks, asset managers, pension funds, and central banks around the world will hold some amount of US Treasuries, which is why they're considered to be so important to the financial system and the global economy as a whole. As we've explored, the US Treasury's status as the backbone of the global financial system is based on the assumption that the US would never dare default on any of this debt, as it would completely ruin their credibility and blow a massive hole into the foundations of the financial system. However, the arrival of Donald Trump has cast doubts over this assumption, and over the last few months we've seen hints that he might be thinking about the possibility of a default. For example, back in December, in an interview with ABC News, Trump said that a default would mean nothing, but psychologically it may mean a lot. This comment spooked a lot of people, as it indicated that Trump might not be fully aware of the extent of the catastrophic consequences that a US default might have on the financial system. And also in February, Trump stated that his administration was investigating potentially fraudulent treasuries, adding that it could be that a lot of these things don't count. In other words, the stuff that we're finding is very fraudulent, therefore maybe we have less debt than we thought. And again, this has got a lot of people worried. It's not clear exactly what they're looking into, and who decides whether a treasury is fraudulent or not, which again casts doubt on the assumption that an investment into treasuries would be completely risk-free, as someone from the Trump administration could come along and just say it was fraudulent without really proving what they mean. But it's not only these few comments made by Trump that have people worrying about a US default. It's a fact that the US government are running a massive budget deficit at the moment, as in they're spending way more than they bring in via taxes, so we're being forced to borrow large sums of money on top of the massive debt pile that already exists. And with interest rates as high as they are, it's becoming more and more difficult for the US government to keep up with their interest payments, and they're having to borrow more just to service the interest on their current debt, which risks ballooning into a vicious debt cycle. And all of this stuff will come to a head at some point this year, as it's projected that the US government will hit what's known as the debt ceiling at some point in late 2025. Now, I won't get into the ins and outs of what the debt ceiling is, but essentially all you need to know is that it's an arbitrary rule which is set by Congress, which sets an upper limit on the amount the US government can borrow. And if the US government were to hit the ceiling and Congress refuses to raise it, then this could lead to a guaranteed and immediate default. Now, it must be said that Congress have raised the debt limit many, many times in the past, as the debt pile has got closer and closer to the limit. But both Democrats and Republicans like to use the threat of not raising the debt ceiling in order to get concessions from the other side, which has led to some pretty ugly and nerve-wracking political standoffs in the past. And with the political landscape in America as toxic as it is at the moment, many people are nervous about what might happen when the debt ceiling needs raising yet again. So it's clear that there are more doubts than ever surrounding the risk-free nature of US Treasuries. In fact, betting site Polymarket places a 6% chance on a US default on its debt in 2025. But what could actually happen if the US were to default on its debt? We've said that the Treasury is the backbone of the global financial system, but could we actually see another 2008-style financial meltdown if the Americans were to refuse to pay their debts? So, in my opinion at least, a US default would be pretty catastrophic for the Americans, but also for the wider global financial system and the global economy as a whole. As soon as the first default happens, a 250-year perfect credit history is completely evaporated, and the assumption that the US Treasury is one of the safest investments in the world is immediately proven untrue. And following a default, there'd be a number of knock-on effects. Let's start by talking about what might happen in the short term. Firstly, investors around the world would inevitably panic and dump their holdings of US Treasuries onto the market. This would firstly cause a liquidity crisis, as billions or trillions worth of treasuries flood onto the market, with not enough buyers to mop up the excess supply. As a result, treasury prices would plummet, as everyone is selling and no one is buying, causing yields to spike, meaning that the US government's borrowing costs would absolutely go through the roof, pouring more fuel onto the debt crisis fire and making the problem even worse and the risk of future defaults even higher. Secondly, there's also a good chance of a stock market crash as panic spills over into other asset classes. Thirdly, as the US has struggled to borrow more money thanks to the liquidity crisis in the treasury market and the super low prices which are on offer for these treasuries, they could struggle to meet their day-to-day spending requirements, meaning that payments such as Social Security, Medicare and military salaries could be severely delayed. And finally, investors around the world would rush to put their money in other safe assets, causing major spikes in the prices of gold, Swiss francs, European bonds or even euros themselves. So broadly, these are the short-term impacts that we could expect to see following a default. But what could we expect to see over the long term? Well, inevitably there'd be permanent damage to America's financial reputation, and US treasuries would never again be seen to be risk-free, meaning that the borrowing costs for the US government would permanently be higher, as US treasuries would always demand a risk premium from now on. We'd also likely see a recession in the US. We've already seen a contraction in their GDP of 0.3% in the first quarter of 2025, and this trend would very likely continue in the event of a default, as business and consumer confidence would be permanently and severely damaged. And inevitably, this would make the debt crisis infinitely worse. As US bonds are no longer as desirable as they were, their prices would plummet, meaning that their yields would spike, essentially meaning that it would be way more expensive for the US government to borrow money, which they need to do if they're going to maintain their current level of spending with the current level of taxation in the country. And this would probably force the government to make some pretty unpopular decisions, such as raising taxes dramatically or slashing spending on things like the military, Medicare and Social Security. So as we can see, a default would be pretty disastrous for the Americans, but it also wouldn't be great for the rest of the world, as the big institutions like banks and pension funds would have lost an absolute ton of money on their holdings of US treasuries. And in some extreme cases, governments might even need to bail out some of these institutions, like they had to do back in 2008. So clearly, a default would be pretty disastrous, but how likely is this to actually happen? Now, nobody can say for sure what Trump or his administration plans on doing next, but in my opinion at least, a US default is incredibly unlikely. All you need to do is take a look at the disastrous consequences that would happen as a result of a default, like we've just discussed, to realise that no matter what Trump might hint at or how much he hates the debt burden, there's absolutely no way he'd risk such catastrophe on his own economy. For me at least, the example of what happened after Trump's Liberation Day tariffs, as in the fact that he walked them back after the markets freaked out, really shows that the markets do have a hold over Trump, and if the markets don't like something, Trump will actually think twice about doing it. That said, however, defaulting on debt is very different to announcing a load of tariffs, as the tariffs can just be cancelled or delayed, and the market's allowed to rebound. But if the US government defaults on just one treasury, their reputation and creditworthiness is tarnished forever, and the damage done to the markets can't be reversed. And it's this point that makes me nervous that a default could possibly still occur, as there's no way of Trump testing the waters of the market before he actually does it, like he's done with tariffs. It'll either happen or it won't happen. And if Trump does decide to take the plunge, there's really no going back. If you've made it this far, you might find some of my other videos on the channel interesting, as we've got plenty more on the topics of investing and the economy, and many more in the works to come. And please drop me a like and consider subscribing if you've enjoyed. Thanks for watching.